Hi everyone, welcome to today's session. I'm the Partnership Manager of Airwallex. Today webinar is about expanding your scale-up globally and beyond, brought to you by Airwallex and Nuwaru. A very interesting topic that we're focusing on today, particularly useful for companies moving from the startup phase to the scale phase. And we will examine what are the key challenges you'll be facing and what are solutions available. From Nuwaru side, we have David Early, the founder partner of Nuwaru, Sophie tax manager, and also Leslie Pescoha, a specialist consultant, join us today. And from iWork side, we'll be having our accounting channel partnership manager, Henry Bond, who will be highlighting the typical issues that we face by scale and also what are solutions available. So please be reminded that today's session will be interactive. So please post any questions that you may have on the chat, and I will bring them up to the speakers. Without further ado, I'll ask David to kick us off.
Thanks, Kyle, and thanks everyone for joining today for today's live webinar, which is the last in our series on tax issues for scale-ups. So just to, Kyle's introduced us, but a bit more detail. I'm David Early, corporate tax partner with Nuwaru, specialising in international tax and employee share schemes. And with me today, we have Leslie Prescott-Ha and Sophie Day, our transfer pricing specialists. So Leslie's got the fun to do the talking today, and Sophie does, and Leslie's in the background to answer the difficult questions that you may pose at the end. So hopefully some of you have had a chance to look at the videos in the first three of our sessions on this. The first one dealt with structural setups for scale-ups. The second one with employee share schemes and some issues for employee versus contractors. And the last one dealt with debt and equity and what's the different consequences with using either of those to help you scale up. And I guess just quickly, when we're talking about scale-ups, what scale-ups really mean? What we're really focusing on here is those businesses that have moved from the startup phase, been very successful, and now they're in that next phase of rapid expansion. They've got proof of concept, and now they're scaling up domestically, and now, as far as this webinar is concerned, globally. So we're going to touch on the various tax issues to consider associated with that. So I'll just share the slides here for you. Great. So specifically, what are we going to cover today on the offshore expansion? The topics are optimizing your global effective tax rate. Then we're going to look at avoiding the accidental permanent establishment. Then how is it best to finance the offshore expansion, transfer pricing issues, withholding tax, and lastly, tax residency. So just dealing first with optimizing the global effective tax rate. What do we mean by the global effective tax rate? Unfortunately, we haven't yet moved to a standardized corporate tax rate across the globe. So we have a large variety of rates from 0 up to sort of you're still in the 40%. So as you do business in different countries and you set up different establishments there and you're subject to tax in those countries, you're subject to all those different rates. So your global effective rate is your blended rate for your consolidated group. So clearly, the lower the rate, the better the outcome. You've got more after-tax profits to deal with. So that sounds pretty simple. Why don't we just maximize the profits in the low tax jurisdictions, or better still, no tax jurisdictions and some tax havens? Job done. We've got a global effective tax rate of 0. Unfortunately, it's not that easy. There are a range of anti-avoidance provisions and other provisions which are designed to inhibit you doing that. And in fact, over the last few years, the OECD and the G20 have had a specific project to stop the big guys in town doing that. particularly the Apples, the Googles, Starbucks, etc., all of which were established with a lot of their intellectual property in a low tax jurisdiction, and they're now introducing rules to stop that occurring. So it's a bit of a balancing act. At the end of the day, you can put some profits in lower tax jurisdictions, but what do we have to navigate around and think about when we're doing that to see whether it's actually effective to lower your global effective tax rate? So on the page here, we've got a list of 5 items that we have to think about. First of all are the CFC rules. What's that stand for? Controlled Foreign Company Rules. In short, how they work is if you've got a subsidiary in a foreign country that you control, then the non-active passive type income, such as interest, dividends, royalties, etc., to the extent they're taxed at a low or no rate, will effectively be attributed back to the Australian parent company and taxed in Australia. Active income, on the other hand, from carrying on an active business, so long as it's not in a unlisted country with a low tax rate, will avoid these rules. But clearly, you can't sort of put all your, for example, intellectual property in Bermuda with a 0 tax rate, pay a whole lot of royalties into Bermuda, and think you're going to have a 0 effective tax rate. That will be passive income and generally attributed back to the Australian parent and taxed at the Australian corporate rate. The next area is transfer pricing rules. I won't steal Sophie's thunder. She's going to talk to that. But in short, to the extent you've got international related party transactions, be it service charges, be it financing cost, royalties, dividends, interest, etc., then they have to be priced at on an arm's length basis or a commercial basis. So you can't artificially change those amounts to sort of push more income into certain countries. The next thing we need to navigate, and particularly when you're funding some of this with debt, is the so-called thin capitalization rules. Those rules are designed to stop you loading up your debt in Australia and funding your offshore operations through equity, for example, which has the effect of putting all your interest deductions in Australia and all your income in the other country, which may have a lower tax rate. Generally, depending on the nature of the business, you've got to operate within a 1.5 to 1 debt to equity ratio to not trip up on these rules and start to lose your interest deductibility in Australia. The next area is withholding tax. Clearly, we don't want to set it up fantastically only to then lose it all in withholding tax leakage. So withholding taxes generally will apply to interest, dividends, and royalty flows across cross-border, and they'll be at rates of anywhere from 0 to 30%, depending on the country involved. So to take that other example, if we successfully put all our intellectual property in a tax haven with a 0 tax rate, and then we paid a whole lot of royalties from Australia into that entity to try and push it into a low tax jurisdiction, those royalties would be subject to a 30% withholding tax. So really, you're better off leaving it in Australia at 25% or with whatever rate between 25 and 30% you have in Australia. So you've got to be very careful about that, and that doesn't just destroy the structure that you've set up. And lastly, we'll look at subsidiaries in foreign countries that accidentally become Australian resident rather than foreign resident. You need to be careful how you manage those entities. Otherwise, the ATO in Australia will consider them to be Australian resident and taxed at the Australian corporate tax rate. The next topic I just wanted to touch on was avoiding the accidental permanent establishment. So in the early stages of setting up your business and expanding offshore, you may be selling your products and services into various offshore countries from Australia. So at that point, you may have some GST and other considerations, but generally, from a corporate tax perspective, you'll be just taxed on what you're selling back in Australia. But as you start to scale up, you might either contract or employ some people in the foreign countries. You may start to you may set up an office in those countries, etc., just to help manage your distribution or your sales of your products and services in that other country. There's some fairly strict rules on that you need to stay within before you trigger what's called a permanent establishment, or in sort of more layman terms, a branch in that country. Because if you trip over that and cause the permanent establishment there, you will be taxed in that foreign country. Depending on where that country is, that may or may not be exempt from tax back in Australia, or maybe taxed back in Australia with a credit for the foreign tax. But the sort of things that can trip you up there's a number of tests. You don't need to satisfy all of them, just one can trip you up. Often there's a day test. So if you've got people physically present in the foreign country and they spend more than a certain number of days in that country, it can be anywhere from 90 for some countries through to 180 in other countries, that can trigger a permanent establishment and a taxable presence in that foreign country. Similarly, another one may be if you establish a branch or an office in that foreign country, which is considered a fixed place of business. That in itself can cause you to have a taxable presence and a permanent establishment in that foreign country. So if you do trigger that, then basically the profits attributable to that permanent establishment, which is calculated as if it is a separate discrete entity, even though it's legally not, will be taxed in that foreign country. So it's really important to track what you're actually doing in that foreign country and how long people are spending there, that you don't inadvertently trip up on this if the plan is not to actually create a permanent establishment. On to financing. Fortunately, offshore expansion or any expansion takes money, so we need to source the money. So what's the best way of doing that, and how do we structure that? So there's really two ways. It's either debt or equity. Those of you watched the last video, Peter spoke to this at length, so I won't sort of reinvent the wheel and go over it all again here, but in short, when you use debt, that brings with it interest deductions. With equity, there's no deductions. Whatever you pay out is a dividend ultimately. So by putting your debt into a foreign subsidiary, they'll have interest deductions, and obviously that will drive down the taxable income in that country. You may or may not want to do that. For example, if it's a low tax jurisdiction, you probably better not to do that and to fund it with equity and leave the debt in Australia at a higher tax rate. Other factors then come in. Where do you source the loan? If you do have to borrow, you don't have enough reserves in Australia in the parent, then you will have to borrow from externally. So do you borrow from the parent and on-lend it, or does the subsidiary borrow directly? So on the equity funding side of that as well. So if you do borrow in the parent level and then you inject equity into the foreign subsidiary, so you push the deductions into Australia, as we touched on earlier, you'll have to be careful that you don't trip up on the thin capitalization rules. There are some borrowing and on-lending concessions if you're on-lending to the foreign subsidiary, but if you're going to inject equity, then you may trip up and lose some of your deductions in Australia. So if you do borrow and on lend, you may navigate around that CFC issue, but then you've got to be careful that you actually price the interest charge on the loan on an arm's length basis. Otherwise, the ATO will come along and attribute more income to you. You also have to think about withholding tax. So when the foreign subsidiary pays the interest back to the parent, there will often be a withholding tax leakage depending on the country and whether the double tax treaty for that country may relieve it in whole or part. So whilst that withholding tax on the amount received by the parent is often creditable against the corporate tax in Australia, that's not always the case. For example, if the parent has tax losses in Australia, that foreign tax won't be creditable and you'll lose it. So it results in an absolute leakage. So if alternatively you want to avoid all that and the subsidiary just wants to borrow directly, that does overcome some of those tax issues. But invariably, if the subsidiary borrows directly, it'll be at a prohibitively high interest rate because often lenders won't have regard to the parent if they're just looking at the subsidiary alone. To get that rate lower, then they're going to generally want some sort of a parent guarantee. And then we have to look at, well, at what price should that guarantee come at, which invokes some of the transfer pricing considerations, which is probably a perfect time to hand over to Sophie to talk about transfer pricing.
David, excuse me, I have a question from the audience. So the question is, what impact will be a global minimum tax have on offshore expansion? Do you want to answer that before passing to Sophie?
A global minimum tax?
Correct.
Yeah. Okay, part of these new rules that the OECD and G20 have been introducing is a global minimum tax rate to try and stop the big guys from, as we mentioned earlier, putting all their IP in a tax haven. So the proposal at the moment out there, and this only applies to what's called significant global entities at present, means you've got a turnover of 1 billion or more. So probably doesn't apply to most of us on this call today, but can in time. And the objective of that is to actually, and I think the proposal at this stage is a global minimum rate of 12.5%, magically set because I think the rate in Ireland where Google and others have set up is 12.5%. So it'll lift the rate to 12.5%, meaning any of those tax havens which have a rate of 0 or up to 12.5%, it'll force the profits to be essentially taxed and redistributed at that 12.5%. So it's designed to discourage the putting of your intellectual property in those low tax jurisdictions. To me, 12.5% is still pretty good compared to 25% in Australia. So there will be room to still do this, subject to all the other restrictions that we mentioned earlier, but it'll stop the big end of the game who are putting their profits into the tax havens. Hopefully that answers that. I'll hand over to you, Sophie.
Oh, thanks, David. And thanks to Airwallex as well for hosting this online webinar. Can I just get the next slide there, David? So as a bit of an overview of transfer pricing, all international related party transactions and dealings must be undertaken on an arm's length basis. This includes terms, conditions, decision-making and pricing. Some examples of these include financing, and we'll touch on that specifically in a while, management services, distribution services, intellectual property and business restructuring. Financing, IP and business restructuring are typically the most complex areas of TP. So in Australia, the TP law, which is in subdivisions 815B to E, applies to transactions wherein a transfer pricing benefit arises from non-arm's length cross-border conditions. And the Australian TP law must be interpreted and applied to achieve consistency with the OECD guidelines. So just on the next slide there, please, David. So in transfer pricing, it's essential that businesses get it right up front to both reduce risk and drive long-term strategic outcomes. For new transactions and startup operations, upfront analysis is materially preferable. For example, we have a client that recently started manufacturing operations in Malaysia who have a tax holiday. We were able to implement a profit split mechanism which took into account the tax holiday and location cost savings, which meant ongoing maintenance of this transaction was much more straightforward and resulted in a practical and effective outcome. Whereas subsequently correcting inappropriate TP practices can be problematic. So the arm's length principle is quite straightforward in theory. Essentially, it means that price agreed in a transaction between two related parties must be the same as a price agreed in a comparable transaction between two unrelated parties. However, the arm's length principle is more difficult to sustain in practice. The key to acceptable TP practices is the appropriate application of evidence, that is, proper consideration of, for example, all the internal and external benchmarking data available, and that's not just the benchmarking data that's most favourable to the position. Internal uncontrolled transactions, and such transactions are actually often disregarded. The positions of the parties to the controlled transactions, and this is particularly important because revenue authorities often don't have regard to the parties for the parties to the transactions that are based in other jurisdictions, business changes and business decisions, and economic conditions and changes, which is particularly important during these COVID periods. In terms of the risks of transfer pricing, aggressive international tax planning has led to increased scrutiny of multinationals in recent years. And this includes the OECD, UN, and country-specific actions such as diverted profits taxes, which have been implemented in Australia and the UK, digital service taxes, which have been proposed by many countries but not implemented by many, multinational PE avoidance laws, country-by-country reporting rules, and country-specific rules and guidance, which is especially in Australia. So as a consequence of all this, the sea change in transfer pricing legislation and global TP guidance has resulted in a new normal in transfer pricing practice. This is for multinationals, revenue authorities, practitioners, and professionals. And this new environment does increase tax risks for multinationals. In practice, disputes should be avoided as the key TP risks do arise as a result of these disputes, and numerous cases can have a domino effect. Where possible, advanced pricing agreements and safe harbours should be leveraged. For example, the ATO, as well as the OECD and other tax administrations, have introduced simplification procedures or administrative safe harbours for low value, low risk controlled transactions. This typically reduces compliance costs and applies to things such as inbound and outbound loans, intercompany services, small distributors, amongst various others. These safe harbour provisions typically alleviate the necessity for formal benchmarking to comparable uncontrolled transactions, but they don't alleviate the necessity for general transfer pricing analysis and documentation. So, for example, for intragroup services, various of our clients rely upon the profit margins outlined in the ATO's simplification procedures, but the nature and extent of the services and the computations of the transactions must still be documented based on transfer pricing principles. These safe harbours and other guidance are particularly important for newly established international operations and controlled transactions, but do be aware that there are a lot of fish hooks in relation to these that should be considered. If an APA or safe harbour is not available, appropriate TP analyses and documentation become critical. Hence, policies, documentation, and information gathering processes are extremely important, and this also includes the ongoing management and maintenance of these. There are very onerous documentation and disclosure obligations to the tax authorities to support the arm's length nature of the international related party dealings. In Australia, this may also include things such as PCG risk assessments for inbound distribution and loan transactions, as well as considering country-by-country reporting requirements. Just on to the next slide, please, David. So there's been significant TP focus in recent years on financial transactions. such as loans, guarantee fees, and cash sweeps. For financial transactions, particularly in Australia and New Zealand, we've really departed from the arm's length principle as typically applied. On one hand, you've got the OECD guidelines, which refer to the concept of implicit parental support. But then more recently, there's the Chevron Australia case, which introduces the idea of the orphan theory. This case basically says your intercompany pricing should be based much more on a group approach, where the terms and conditions the group uses and the group's intercompany policies, such as guarantee fees, should be taken into account when seeking to apply the arm's length principle to financial transactions. So it is important to consider whether there are any country-specific laws and cases at play, such as the Chevron Australia case just mentioned, and also in New Zealand, the recently enacted law relating to inbound cross-border related party loans. It's important to also understand that the TP provisions often need to be considered together with other taxation provisions, some of which David's already discussed, like thin capitalization, withholding taxes. For financial transactions, our TP analyses would typically cover, firstly, accurate delineation under OECD guidance, and this includes consideration of debt versus equity characterization and the arm's length terms and conditions. You can then move on to analysing the arm's length debt capacity, and then finally you can consider arm's length pricing, i.e. the interest rate, which includes a credit rating analysis and a credit spread analysis and adjustments. More specifically in Australia, a PCG 2017-4 risk assessment must be undertaken. So this is a self-assessment tool to classify the level of risk associated with a particular related party transaction. It's also important to consider if there are any administrative safe harbours available. As mentioned previously, the ATO has safe harbours for low value, low risk inbound and outbound loans, which are under AUD 50 million. But do remember there are fishhooks that may prevent appropriate application of these. And it should also be noted that the safe harbour interest rates are very low. So to wrap up for financial transactions, it has been particular focus on these from the ATO and also from the IRD and other tax revenue authorities worldwide. So a proper consideration of these transactions is definitely recommended. So that's all from me. I'll hand it back to you, David.
Great, thanks, Sophie. That was good. Just before we hand over to Henry and Kyle and get away from tax, just to round out on these 2 points, we did talk about withholding taxes a little early, but I think it's just useful to revisit it because it's often forgotten in the process. And so, yeah, four steps here to consider. First of all, it applies to interest, dividends, and royalties. Interest is generally 10%, can sometimes be reduced to 0 or less, depending on the country involved and whether the double tax treaty limits that rate. Dividends can be 0 to 30, again, can be limited to down to as far as 0 under certain double tax treaties, and royalties up to 30% as well. Often can be reduced to 10, and in some rarer cases can go down to 0. So critical that you do sort of factor that into the equation and whether you get a credit, because it will result in an absolute leakage and additional cost to the organisation. And as Sophie's mentioned, transfer pricing equally applies to these flows as well to ensure it's commercial and arm's length amount. And just lastly, I mentioned this a little bit earlier, tax residency, a forgotten sleeper. What can happen is you set up a new subsidiary in a foreign country for various commercial or legal reasons, and naturally being incorporated in the foreign country will drag it into their tax net as a tax resident country in whichever country that may be. Then what can happen is if the place of central management or the central management control of that vehicle is in fact occurring in Australia, the ATO is likely to challenge that to be an Australian resident company. So suddenly you've got a dual resident company. What do you do? Depending on the country involved, if it's a country with which Australia has a double tax treaty, many of them will have a tiebreaker, which deems the country in which the central management takes place to be the country of residence. So if in fact it's being managed and controlled from Australia and it's a resident in another foreign country, then the treaty will override it to say that it's a resident in Australia and not the other foreign country. That's not always the case. There's some treaties which don't have that tiebreaker. The US is an example, in which case you can end up being dual resident, which becomes quite messy. So there is a laundry list of things to consider and do to avoid this occurring. But just on the right, I've listed a few of the basic ones, and that is, generally it's considered where a company is controlled as by the board. So where the board actually meets and the meetings are chaired from is crucial, and that should be in the place of incorporation and not back in Australia. There also should be substance in that foreign subsidiary. It can't just be a postbox existence. So some people or an office or something to give it some substance is critical. And day-to-day operations occurring in the foreign country is not enough. The key decisions need to take place in that foreign country as well. They can't just be sort of exercising on the commands of people back in Australia, or the ATO will consider that to be resident and controlled back in Australia. So that's probably it for tax. I'll hand back over to Kyle and Henry to take us through their part of the presentation.
Thanks, David. Before we handing it back to Henry, Sophie, we have a question for you from the audience.
Excellent. I might cover this one off and give Sophie a bit of a break. So James, thank you for your question, which is, do the transfer pricing rules apply to all businesses, or are there thresholds? I would say across jurisdictions, the transfer pricing rules do typically apply to all businesses, but the tax return disclosures and/or the C-by-C reporting requirements, the approach to benchmarking, the nature and extent of revenue authority scrutiny, the application of safe harbors or simplification procedures can all vary depending upon the size of a business. So whilst the law unto itself may be applicable to all businesses, the way that the law is applied practically can be very different, whether you're dealing with, for example, a significant global entity versus a very small business. And then, just more fundamentally within multinationals, it's very important to take a risk-based approach to transfer pricing.
Oh, good. Thanks for your help, Leslie. So now we're going to pass to Henry from Airwallex.
Awesome. Thank you very much, everyone. I'll just quickly share my screen. And while I do that, I'll just introduce myself quickly. Hi, everyone. I'm Henry. Like Carl said, one of the accounting partners here at Airwallex, and work exclusively with accounting partners and bookkeepers, educating them around the platform and how they can best help founders, startups, and SMEs, as well as with businesses as well, in terms of how they can use the platform themselves to work on a global scale. So today I'm going to be going through a couple of things with you. First, I was going to give you a bit of a run through of Airwallex. You might have heard it before, might have not. I'll make sure that by the end of today that you have a good understanding about the platform. A bit of insights that we've seen in the global SME space, and sort of where the opportunities lie when thinking about going global. Thirdly, around some of the barriers and challenges that we've seen scale-ups and startups have when looking to go abroad. And then finally, if you have any questions at the very end, obviously feel free to put them in the chat as we go along. Happy to answer them at the very end for you. But first, I thought it'd be great to just understand, where did Airwallex come from? How did this idea come about? And it actually began before the company existed. All the co-founders actually used to run a cafe in Melbourne, still there today. And while they were running this cafe, they had a lot of challenges when it came to paying suppliers overseas. Took a long time for the payments to receive the payments. It wasn't the exact amount a lot of the times. There were a lot of transaction costs and high FX exposures, the whole lot. And what they discovered was not just from their own experience with running the cafe, but also from working in the industry for quite some time, was that there was a gap that they could try and fix for small to medium businesses who wanted to be able to be a bit more efficient with working with different teams, different stakeholders around the world, and mitigating as much cost and exposure to FX as possible when managing those teams. And the way they did that was essentially creating this ecosystem, which is now known as Airwallex, to allow those founders, those businesses, to compete on a global level way more efficiently than previously. And that's where it's got to Airwallex today. And I think it's important to note that in its formative years, a lot of time was invested in building out the platform, ensuring that we are compliant in every region that we operate in, that we have our relevant banking partners supporting us and our services in each region, so that today, when a customer can come on board, they can essentially operate anywhere in the world when need be, and use a range of features in order to operate, reduce a significant amount of cost the way that they operate, and be a lot closer to their customers than previously be. So right now we're valued at just over $5.5 billion US, which is fantastic. We're actually more than 130 countries and growing. And then we've actually got 13 offices as of a couple of days ago too. So that's a nice little update. And then we're also backed by some other major players in this space as well, which is awesome to see. But I guess like how they got to this stage was because they noticed that not just within their own experiences, but also with the customers that come on board. We've been fortunate to see some household names come to the platform who were obviously relatively unknown to where they are today. And a lot of them had the same trajectory of thinking in terms of having a global mindset from day one when they set up their startup. It's probably not a surprise that some of the more mature markets, some of the more bigger opportunities lie outside of Australia. And I think the likes of COVID, the likes of the current macroeconomics as well, has made it seem that if you're to survive as a business today, you need to be thinking globally in order to really try and enhance that customer base that you want as a business. But what's most interesting is that Australians aren't actually thinking globally. Despite all that, e-commerce, for example, is an industry which you need to be thinking globally because anyone in the world can purchase your goods from your website. Yet Australians are a bit fickle when it comes to that. In fact, they don't seem global business as a means of selling, but actually buying. So what we see here is actually where SMEs are, sending, I guess, most of their money overseas, according to Airwallex. And what we see is that there's actually a stronger affinity to some of the supplying countries as opposed to the more consumer countries. So seeing things like, Southeast Asia, China, Indonesia, purchasing goods and services from there, and then perhaps shipping it back to Australia. But where what's interesting is that the likes of the UK, the US, Canada, and some of the other developing countries are really underutilized in terms of Australia offering their products and services to those regions. And I think the reasons for that is obviously there's what we discussed beforehand, but I think also because there's not enough information out there today to say, hey, it's actually really easy to operate in different markets. There's Airwallex aside, there are plenty of apps out there and plenty of services that companies can use in order for them to operate in these different markets. Obviously, we facilitate from like a payment perspective, but there's heaps of other sort of recruitment software, legal software out there that different businesses can actually input into their small business to make them operate a lot more efficiently. And why that's important is because this is the last thing you want to be thinking about as a business owner. You want to be thinking about growth and thinking about how can I take my business to the next level and not worry about these other sort of nuances that come with doing business globally, where these app partners can come in and really, really help and drive growth for you guys. Now, in terms of like, what are those barriers that we do see that occur if you're a business and you're wanting to go overseas? I guess the first is like setting up a bank account. Like, I don't know if anyone's done it before, but flying over to a location to go to the bank and physically hand in your notarized documents in with the bank teller and hoping that everything there is correct when you do so can take a bit of time. Airfares, I'm sure you've all seen them today. They're a little bit costly. So it's something where it does, as like a founder, you don't want to be thinking about that cost or actually physically doing it yourself. Fortunately, with Airwallex, once an account is set up for the business, they can instantly set up a bank account in multiple regions to receive, hold, and pay out that same currency. And we're looking at anywhere in the world, from the UK, US, Europe, Singapore, Hong Kong, New Zealand, Canada, just to name a few. The second would then be actually paying contractors or employees in different regions as well, and try to understand, firstly, what is the true cost of sending funds to these individuals straight away. A lot of people aren't actually aware of sort of the hidden costs around moving funds from A to B overseas. A lot of the time, it takes a while for funds to go from Australia to the recipient's bank account, just because the nature of the existing banking infrastructure that's set up today isn't allowed for smooth, quick, easy payments. Where we come in is, again, because a lot of time was invested to allow businesses to move funds smoothly and quickly from A to B, we mitigate a tremendous amount of cost and time for businesses who want to be able to move funds from Australia to anywhere in the world. And then moving on to, I guess, when a business, and especially we see this a lot in sort of the B2B, the tech space, e-commerce, where especially COVID has definitely made an impact to this. When if you're trying to grow quickly and you're trying to identify new customer bases for your business, a lot of the time social media was like a huge aspect for this, to try and drive lead generation for a business, and to help speed up efficiencies within the business. A lot of the time businesses would lean towards US-based subscriptions or software to help obviously run the day-to-day of the business. So that's everything from like CRM software, even Zoom can be to a certain degree, or obviously Facebook, Instagram, and those sort of platforms. All are designed to create efficiencies, but at the same time, a lot of these entities are based outside of Australia, and what might not be well known to founders is that using a bank card, using your standard bank card to pay down a lot of these subscriptions, there are a lot of hidden fees associated with paying down these costs. If you use any bank today, you'll get hit with 3% instantly per transaction when paying down overseas expenses. And then that's excluding what the conversion rate would be with the bank as well. So despite the fact that there's a lot of cost there, a lot of the time founders don't even know much about what those costs actually are. So one side of the coin is just taking a step back and looking at what are those costs that you're paying down that you can potentially avoid yourself. And then secondly, if it is something you want to try and drive down, we've got a really amazing cards product, which reduces FX exposure on purchases by 90%, and really makes an impact to the business's bottom line as a result. And then finally is, how can we receive payments from our clients again? Like I said before, we're able to set up essentially banking facilities in different regions to receive, hold, and pay out freely. But a lot of the other time is, how can we receive card payments a lot more efficiently as well? And I'm sure that there's some brands out there that use all sorts of platforms to get closer to their customers. The Shopifys of the world, the PayPals of the world. They're very well set up for domestic use, but in terms of international use, a lot of businesses aren't aware that they force convert at around 3% of sale or funds, that go back from the overseas country to Australia. Using us, we can receive those card payments a lot more efficiently, costly, and also be able to convert those funds back to Australia at a much more reasonable rate as well. So those are some of the risks, I guess, that we've seen in in this space. I'll pause for a second. If anyone has any questions, I don't have the screen up in front of me, but if anyone has any questions and would like to ask me one, I'm more than happy to answer them for you.
Henry, it's okay for me to start the Q&A session. So,
Sure.
Most common question coming to us about Airwallex is Airwallex reliable?
Yes. Couple of things. So I guess reliable is it's pretty broad question to say, but I think the first and foremost one that we get around reliability is security and trust. And like I said, in order for us to sort of operate in each region, for us to be able to serve our customers, we had to adhere to the rules and regulations of each country. We had to have banking partnerships in each location that we operate in, so that we can essentially allow customers to operate all around the world. So in Australia, for example, we partner with ANZ. ANZ is one of our partnering banks. And when Australian businesses come on board, their funds are actually stored in what we call as like a client segregated trust account in ANZ, where firstly, all our Australian clients can see their funds stored in that space. And then secondly, if anything was to happen to Airwallex, God forbid, the funds can be safely distributed back to our clients at a later date. And furthermore, when Airwallex is in the fintech industry, fintech by nature is a high risk industry and tends to be seen by regulators in quite a strong way. And so we have to have the same level of banking standards, if not more, in order for us to really compete in this space. Without trust, we won't have customers. We won't be able to operate as a business. So if we were to ignore that, then that would seriously impact sort of the standards that we can operate at. But we actually aim to sort of be a level beyond banks when it comes to that. Because we're a technology company, we can identify where funds are going to or going from. So from an AML perspective, we're light years ahead when it comes to identifying any risks that occur from like a fraud perspective or inappropriate transactions.
Thanks, Henry. So we have one more question from the audience. So what's our coverage in New Zealand? Do we cover New Zealand dollar?
Yeah, good question. And good timing for that as well, because as of about a bit more than 2 weeks ago, we weren't able to onboard New Zealand customers locally, meaning we weren't able to give them local support. The entity in New Zealand would have been set up in Hong Kong, so it just wasn't a great experience. We can now onboard New Zealand businesses onto Airwallex using their New Zealand entity and have local support in New Zealand. They're able to set up local New Zealand bank account as well with us to receive, hold, and pay out New Zealand dollars. Previously, we weren't able to do that. We were only able to do pay out New Zealand dollars. They will then also be able to set up banking facilities in different regions as well around the world. They yet will have access to things like card features. That's on the roadmap. It's just the banking facilities that they'll be able to set up. But you'll still have the benefits of doing things like plugging into Xero if they're using like a Xero accounting software, for example, and working with your accountant that way. That's everything from me. I might pass it back to you, Kyle, if that's okay.
Let me see. I think we are almost time. There's one more question from the audience. I'll see whether you want to cover that. It's just a follow-up question from David. So what's the rate for converting New Zealand dollar versus other banks?
Yeah. Yeah. So our default rate is 0.3% markup to the interbank rate. So that you're looking at your New Zealand dollars, USD, pounds, euros, the more common currencies. That's our markup on top of the interbank rate. If you're looking at a bank and comparing us to them, banks range between about 3 to 5% above the interbank rate. So we do see about a 90% reduction in the cost of conversions as a result of that. And then secondly, as well, is that moving funds from, say, New Zealand to Australia using a bank will incur the likes of transaction fees. So they use what we call the SWIFT model, which is essentially the traditional method of moving funds from one country to another. Because, again, we've got that ecosystem set up to avoid SWIFT fees. There will be no transaction fees as a result of that.
And I think we are pretty much running out of time. One last question from David. So for our New Zealand capability, do we have a partner in New Zealand, or do we cover by NZ as well?
Covered by NZ as well.
Perfect. All good. So thank you everyone again. David, Sophie, Leslie, and Henry for your presentation today. Very insightful comments coming out from the session. Please be reminded that this session has been recorded. A replay of this session will be available on your website and also in our follow-up email. So we will conclude our webinar, and we look forward to seeing you again in future. Thank you so much, everyone.
Thank you.
Thank you.
Thank you.